Hi, my name is Jacob Taylor. I'm from Portland, Oregon, and I am a senior at Westminster College studying finance.
Hi, my name is Cole Spooner. I was born and raised in Orange County, California. I'm a senior here at Westminster College studying finance and accounting.
Hi, my name is Han Wenxu, and I come from China. I'm majoring in finance in Westminster College. I'm a senior this year.
Hi, my name is Hayden Schellerin. I'm a senior at Westminster College from Burlington, Vermont, studying finance.
Hi there, my name is Harrison Nye. I'm a senior from Portland, Oregon. I'm studying finance. We represent Team B in this year's business valuation competition. We're going to be doing a valuation on Cerenimbus software.
Welcome to our analysis of Cerenimbus. We have been tasked with advising the founder, Kirby Glad, by way of our analysis and preparation of a proposal. To start, we will look at the story of Cerenimbus, break down their situation in the software development industry, blockchain potential, and key financial notes and remarks. After some background information is provided, we will open with an analysis approach, starting with our own valuation of Cerenimbus, followed by the proposed scenarios for Kirby and the firm. In the end, we will reveal our proposal for the scenarios provided in the story between Kirby and the major shareholders. To start, we will look at the story of Cerenimbus. They are a contract software development company located in Orem, Utah, consisting of 69 full-time employees. They are situated in the rapidly expanding mobile computing space with a track record of positive cash flows, limited capital assets, and long-term capital debt on the balance sheet. Also, the firm has substantial cash and respectable retained earnings.
Cerenimbus is a software company that has a positive and strong track record of growing income. We believe that the possibility for continued growth is supported by their consistent growth of revenue in every category every year. If we take a look at their balance sheet, we can see that fixed assets are increasing also every year. They are also increasing faster and at a greater percentage than current liabilities. Kirby Smart, the firm's CEO, has mastered the ability to manage offshore foreign labor while catering to American customers. This is one of the biggest hurdles, the communication between American customers with offshore software developers. Cerenimbus is owned 56% by a private equity firm. There are 2 associates with 2% ownership respectively, and finally, Kirby Glad holds the remaining 40%.
Now, we will break down future opportunities and extensive plans Cerenimbus has in place. Mobile computing has yet to embrace the blockchain's tech infrastructure and shows great growth opportunity for Cerenimbus before fintech companies and major competitors fill such market space. As of this year, Cerenimbus received board approval to execute plans to grow its foreign operations. This includes adding 3 full-time programmers specifically responsible for marketing and expanding its presence with its domestic clients, as well as an expansion into Bangalore, India. For Cerenimbus, a low-wage, highly productive economy is key for continued success in this space and operation.
This chart maps out expected industry growth for the next 5 years. These percentages were calculated based off Cerenimbus's explicit forecast. They account for different revenue categories, such as applications, different forms of contracts, as well as other forms of income. As you can see, we have increasing expected growth through the year 2022, where it peaks. After the year 2022, we can see growth fall back down to 11% by the year 2024. The main gist of the story here is that we have double-digit growth happening in the industry that Cerenimbus operates in. Adding to what we noted previously, Cerenimbus has a unique position with the blockchain technology. With fintech firms like banks, trading houses, and insurance companies seeking to enter blockchain's infrastructure, Cerenimbus is poised to gain market share due to its developed expertise in this area. If this happens, growth projections can significantly outperform what historical returns and forecasted expectations show. This slide reveals a chart that shows Cerenimbus's projected free cash flow increasing through the next 5 years. We believe this will occur as long as growth operations continue to thrive in Cerenimbus's low-wage, high productivity environment. Another factor supporting the free cash flow contention that we came up with, as well as to touch back and connect with the previously noted slide, is the addition to potential revenue streams funneling into the firms through recent blockchain endeavors. Another important trend to point out on this slide is to highlight the dip in free cash flow reserves, which is due to a projected board approval of a new location. This expansion into Bangalore, India, results in slide in cash flow towards the Bangalore's capital. In this case, it's fixed assets.
For better understanding the value of Cerenimbus, we use the discount cash flow model to value it. We tried to use the build-up method in the cost of capital to find out the WACC, but we found the number was too low and not convincible enough. So we just decided not to use the WACC. Considering it is a tech company and the required return in each scenario is around 20%. Therefore, we choose to set the required return at 20%. We also set a relatively high long-term growth at 3%. All of the numbers are directly came from Kirby. We think it is credible because Kirby met their goals very well for each year. Therefore, we believe they can keep their performance in the next few years as well. The chart reflects the key term from the financial statement, and you can see the revenue and ROIC will keep increasing in the forecast. So we feel very optimistic about Cerenimbus' future. Overall, we found the value of the company is very close to $30 million US.
Guideline transactions. We use 4 parameters for our guideline transactions: SIC code, net sales, EBITDA, and sales date. For the SIC code, we use 2 codes: 7371, which is a computer programming services code, and then 7372 is a design, development, and production of prepackaged computer software code. The net sales parameter was set at a minimum of $720,000 and a maximum of $72 million. Our sales are $7.2 million, and we wanted our range to be 10 times in either direction. The EBITDA parameter was set at a positive. Based on our sales parameter of between $720,000 and $72 million, a majority of those companies had negative EBITDA. We did not want any companies with a negative EBITDA, so our minimum was set to $0. The sales date was the past 24 months. We chose a sales date within the past 24 months because we wanted the most recent market information. We chose to value Cerenimbus at a 50th percentile sales multiple. The reason being is that Cerenimbus is right above the 50th percentile in both sales and EBIT, but right under the 50th percentile for profit margin. So at the 50th percentile sales multiple, we ended up with a value of $28 million for Cerenimbus. Our valuation. Based on our free cash flow DCF model, we calculated a valuation of $30 million for Cerenimbus. Based on our sales multiple model, we calculated $28 million for Cerenimbus. We decided to weight the 2 models differently. We weighted the DCF valuation at 40% compared to the multiples valuation, which is 60%. The reason behind this is that we do not trust Cerenimbus' forecasts as much as we trust the market. With that, the final weighted average value for Cerenimbus is set at $28.8 million.
There are 3 scenarios currently on the plate for Cerenimbus. The first is that a private equity firm is going to sell its portion back to the management through a loan. This loan is at a 12% interest rate. They're basing their valuation at a 9 times EBIT multiple for the existing 2020 forecast. This allows Cerenimbus to return the ownership back to their management. There are some issues with this first scenario. The main issue is the price. Some of the investors in the PE firm are unwilling to negotiate an exit at a valuation of less than $15 million. If Cerenimbus sold at this price, it would sell below the 25th percentile compared to other guideline transactions. We believe, given the current track record and future expectations, this price is too low. In summary of this first scenario, Kirby and the PE firm investors should reject this deal. What happens is Glad increases his ownership in the fund. This is something he does not want to do. The PE firm gets convertible stock as well as 2 board seats. This is bad for the fund and the firm. The PE firm would only get an 11% annualized return. This is based on their $2.4 million investment in the fund 10 years ago. There is a second scenario. One of the investors in the private equity fund has agreed to pay off Cerenimbus' long-term debt and reduce Kirby's ownership in the fund to 10%. The investor is basing this valuation off a 20% discount rate using the existing forecasted cash flows. If Cerenimbus sold for $30 million, it would be above the median sales multiple given the guideline transactions at 4.17. We believe that scenario 2 has the best outcomes for everyone. Glad gets to remain at the firm, but gets to get a retirement check. This is something he has expressed interest in. He wants to stay involved in the firm's day-to-day operation, but wants a little bit of a retirement and to decrease his exposure and liability. This situation also offers the largest payout to the PE fund. Kirby gets a $7 million check, Cerenimbus has their long-term debt obligations eliminated, and they can freely expand into India. The PE firm has paid out $15 million. This is a 20% return based on a $2.4 million investment at a $4.3 million valuation 10 years ago. The final scenario is that Cerenimbus management is prepared to buy out the private equity firm's stake in Cerenimbus. They are going to use the same free cash flow forecasts, but with a 22% discount rate. If Cerenimbus sold at this price, its multiple would be above the median. This is again below the valuation that we came up with, but the only positive we see is the ownership would be returned to the firm. We still think Kirby should reject this offer. Although the PE firm gets its second largest payout, Kirby does not reduce his stake in the firm. Another aspect to include in this story is that the firm will still have the existing long-term debt. We think that the outcome in scenario 2 frees up breathing room for the firm. They can further expand into India, which is part of their plan. Here are the summaries of the final valuations. Scenario 1 and Scenario 3 are way too low and below the valuation we came up with. Scenario 2, given that an outside investor is valuing the firm greater than we think Kirby should take this deal. So what are the best ideas to go forward? As we said earlier, Scenario 1 should be rejected by both the PE investors and Kirby. Scenario 3 allows the firm to be returned to management, but it is costly. Scenario 2 is the best option for all